Welcome back to your own channel, guys. Today we are going to discuss about scientific method of trading with the help of AI. So let's begin in smart trading.
This chart tracks an asset's price through a 50% Fibonacci retracement level. For many traders, this is a standard signal. Wait for the price to drop to the midway point between a recent low and high, and buy the bounce. But the flaw in this manual approach is the human element. Success depends on perfect execution, which is impossible when you're fighting fatigue or emotional hesitation during a market dip. Real trading confidence isn't built on a few lucky wins. It's built on knowing exactly how a specific set of rules would have performed across thousands of past market cycles. Most traders struggle not because their ideas are bad, but because they have no way to mathematically validate those ideas before putting their capital at risk. Algorithmic trading provides the solution. By automating the strategy, you ensure the logic is executed with machine precision every single time. Historically, this was impossible for the average person. Building an automated bot required you to be fluent in rigid, complex programming languages like MQL5. This technical barrier locked retail traders out of high-level data validation, leaving those tools almost exclusively in the hands of institutional developers. Codex changes that. It acts as a bridge between human logic and machine execution, removing the need to learn any code. The workflow is simple. You describe your strategy rules in plain, everyday language, the same way you'd explain it to a friend, in a basic text document. Codex takes that plain language description and autonomously reassembles it into the complex MQ5 code required to run a functional bot. Since the user writes zero code themselves, the trader's role shifts from a technical programmer to a pure strategic thinker. Once the bot is generated, it moves into MetaTrader 5. This is the testing laboratory where the strategy has to prove its worth against reality. For this stress test, the AI feeds the bot one full year of historical Bitcoin price data, forcing it to navigate every market move from the previous 12 months. The AI simultaneously runs the bot across multiple different timeframes, checking the logic's performance on several chart resolutions at once. This process condenses years of potentially expensive human trial and error into just a few minutes of rapid computational analysis. The data reveals a harsh truth. When applied to the 1-minute and 1-hour charts, this specific Fibonacci strategy actively lost money over the course of the year. This comparison chart shows the disparity. While the 1-hour tests failed, the exact same strategy yielded profitable win rates on the 3, 5, and 30-minute charts. The data also highlights the max drawdown, the lowest point the account hit before becoming profitable. Without seeing this specific dip in the data beforehand, a human trader would likely have panicked and abandoned the strategy at the exact moment it was about to turn a profit. This replaces gut feeling with mathematical conviction. You aren't guessing that a strategy works, you have the data to prove it. The primary barrier to algorithmic trading is no longer your ability to code, but the quality of your initial logical premise. AI provides any trader with institutional-level testing tools, ensuring that a hypothesis is verified by thousands of data points before a single dollar is risked. You can start by writing out your own strategy rules and using Codex to run your first backtests in MT5. Once the backtest confirms your win rate, platforms like Delta Exchange allow you to deploy these verified bots into the live market. Your success in the market now depends on the strength of your strategy, not the syntax of your code. Let the AI handle the programming so you can focus on the logic.
Historically, building institutional-level trading algorithms required deep fluency in high-level programming. You had to write Python or PineScript to even enter the arena. That technical barrier is being replaced by a process of semantic to syntactic translation. You provide the logic in English, the machine provides the code. Large language models like Claude now operate as direct translators. They take natural language instructions and output executable blocks of code that are ready for the terminal. To use this effectively, we have to build a 3-tier architecture: the generation layer, the validation layer, and the execution layer. This is an iterative engineering loop. You cannot expect a single prompt to produce a system that survives real-world market conditions. In this environment, technical syntax is no longer the competitive moat. The advantage belongs to those who can design the strongest system architecture. Basic prompts yield generic results.
To force the model to output institutional-grade logic, you must apply rigid system constraints. We begin by assigning the AI a hyper-specific persona, a trader with 15 years of institutional experience operating specifically within Indian market parameters. We then apply a data constraint, instructing the AI to retrieve and prioritize strategies supported by the highest volume of backtested evidence. Finally, we add a defensive constraint. The AI must actively identify and discard the common market traps that cause most retail strategies to fail. By stacking these constraints, the LLM outputs a detailed logical framework rather than a generic set of indicators. The quality of the final algorithm is a direct result of how strictly you constrain the initial generation. Once the logic is formed, we migrate the code into the validation layer, specifically the Pine editor within TradingView. We define the temporal environment for the test, locking the strategy to a 5-minute candlestick intraday timeframe. Theoretical testing is dangerous. Backtested data is only useful if it mirrors the actual physical limitations of a retail account. This shows the gap between theory and reality. Left, infinite capital returns. Right, a 1 lakh capital constraint drops the curve. We apply a 500-unit lot size and a 20% margin, revealing the true mathematical baseline under retail conditions. Mathematical validation only works when you stress test the code against the reality of your own capital. LLM generation is rarely perfect on the first pass. Your initial script will likely contain syntax errors. You resolve this by identifying the specific line failure, for example, an error in line 102, and feeding that diagnostic back to the AI for recalibration. Once the code is clean, you face the danger of overfitting, the error of optimizing a system too heavily for historical data. Overfitting creates an overly strict system. This chart shows an over-filtered strategy staying flat for weeks. We fix this by adjusting the prompt to reduce false breakouts rather than chasing raw profit metrics. The result is a more active, consistent curve. This creates a balanced equity curve that allows for consistent trade setups in various market conditions. A profitable system is sculpted. It requires a continuous feedback loop between fixing code syntax and correcting logical overfitting. A validated strategy can still fail in live markets if the execution is inefficient. High latency will erode even the best mathematical edge. A human operator switching between 4 or 5 different charting and order screens creates a physical time delay that destroys alpha. Systems like Capman's single-screen scalper mode collapse this architecture, removing the delay inherent in manual screen switching. Risk management must be automated. We lock in an auto stop loss at 5% and a take profit at 10% to ensure consistency. During a sudden market shift, an auto reversal feature can bypass the need to manually close and open positions. This arrow shows the system moving from a call to a put in under 3 seconds. This maneuver is highly margin efficient. By buying a put instead of shorting a call, you avoid the heavy 20x margin requirement while maintaining the same directional exposure. Millisecond execution is the only way a theoretical mathematical advantage survives the friction of a live market. Algorithms are asset-specific. A strategy validated on the Nifty 50 will behave differently on Bajaj Finance, requiring domain adaptation for every ticker you trade. We must account for alpha decay. This chart shows a strategy's edge eroding and flattening as the market adapts over weeks. As a strategy becomes popular, the market absorbs that edge. You must reset the pipeline and rebuild the trend to stay ahead. This is a maintenance protocol. To combat alpha decay, the entire pipeline must be rerun and recalibrated every 1 to 2 weeks. Finally, remember the role of the technology. AI is a co-pilot. The human operator must retain absolute decision-making authority over every live execution. This pipeline represents a significant shift in how institutional tools are accessed. It doesn't guarantee wealth, but it does democratize the power of quantitative analysis.